Okay, good day, everyone. Today we are back in our discussion with respect to investment in associates and interest in joint venture. And I think we had this deliberation when we were in chapter 11 of the study material. Okay, and this will be the concluding part, which is part 2 in our discussion with respect to how do we account for investments of an investor in an associate and interest of an investor in a joint venture, including joint operation when it comes to joint arrangements under the requirement of both IAS 28 and IFRS 11, respectively. Now, welcome back. Based on our part 1 discussion, I want us to have 1 or 2 comments, feedback, and discussion before we move to solving the problems that we'll need to use to end this chapter. Over to you guys. Who is willing to more or less make comments? The floor is open. Who is making comments? Can you guys hear me?
Yes, we can.
Okay, you guys want comments based on what we've done last and what we're about doing now?
Okay, I think the last class was basically on investment in associates and joint venture. And we're made to know that if it is investment in associates or if it is in joint venture, then we use the equity method. And in fact, there are 2 kinds of joint arrangements that we have. One is the joint venture, and the other one, I think I've really forgotten the terminology for it. But for the joint venture, we also use the equity method to account for it in the investor's account. So when we use the equity, okay, we can also for the joint venture, it should be recognized at either. Okay, for the other aspect of the joint arrangement that I've forgotten the terminology, it can be recognized at either cost or fair value. But when it is a joint venture or associate, it must be recognized using the equity methodology. And the equity methodology simply means that you have the cost of investment in that particular joint venture, and you have to add you need to add the share of profits to it based on your percentage holding, and you less the dividend. So, and you arrive at the amount to be recognized in the financial statement.
Okay, thank you very much. Who else is making comments?
I think good afternoon.
Good afternoon.
So I think that expose on the joint venture and the joint operations. You know, we have a joint arrangement which you explained. I think that one was an eye opener for me, because joint operation, joint venture, I think I now understand what that means. That the joint venture is also you, in terms of accounting for it, you account for it like an associate. You're using the equity method. So, but the joint operation is you just take care of your liability part portion or asset portion and just book it in you record it in your books. But the joint venture, which is a subset of joint arrangement, you account for it using the equity method, just like you account for an associate. I think that was an eye-opener for me. And that aspect was clear. So I understand what a joint arrangement is and what an associate is. A joint arrangement has two components, which I just talked about. Then we also talked about how it's accounted for, but I wanted to ask a question yesterday. At one point, do you account for it using the fair value method instead of the cost, using cost to account for it? So I think, but I understand that if the fair value is not given, you use the cost. Also, you can also use the equity method, depending on the one that you want to. Using the equity method was well explained, I understand it, and I think I can do that one. The aspect I did not actually, I think I may not be able to work on is how to account for using incorporating it into the consolidated statement in terms of the income statement, how to incorporate that you associate. I think I did it then, but I've not done it again. I would really appreciate if we walk through that one today and see how you can incorporate the associate into your cost of your income statement. And I think that's the aspect I think I would like to look at as well.
Okay, thank you. Well, who else want to make comments before we start?
Okay. Good afternoon, everybody.
Good afternoon.
Yeah. In addition to what other participants, or in addition to their comments, I personally, I appreciate the approach used by the presenter to present the topic, the investments in associates and joint venture. As a matter of fact, this is my first time of having a deep breakdown of the course in my entire life, because I always assume before that joint venture and joint control, even joint arrangements, are synonymous. I don't know that there are a line of differences between the two concepts. But having said this, I believe the other thing I appreciate is the the yardstick used to measure whether an arrangement is a joint venture or a joint control, which we base on both quantitative and qualitative. I think it's another key learning that I hold. Then, uh, what I want to learn more under joint venture and joint venture and investment and associates is how we can actually apply the second method, which we call fair value. As we all aware yesterday, you've put us through on how to adopt cost method. Another thing is, based on the question you gave us to work with yesterday, I discovered that there is alignment of the principle we've learned on business combination, which is how we account for goodwill, which you expect us to marry the knowledge we acquired yesterday with respect to treatment of investment and associates and joint venture. Okay, I think I was able to to lay hands on the assignments, but I still have little challenge, which I believe that you will throw light on today. That is my comments. Thank you very much.
Okay, thank you very much. Let's move ahead now, and we'll start with trying to solve the task that was agreed in part 1 of the session for you to attempt. And by doing it together, we'll be able to more or less see where the differences lie. Okay, welcome back to our discussion. And I want somebody to read this question in which we are required to consolidate the account of the subsidiary and account appropriately for our stake as a group in an associate. Okay, I want somebody to read this, and from there we'll move on. Who is willing?
Okay, let me read it.
Can somebody read?
Pali,
Okay.
I'm reading. Pali acquired 80% of the equity share capital of Suzy as at the reporting date 31st December 2013, when the retained earning of Suzy was 14 million. Pali equally acquired 40% stake in Mami of 1st July 2015 for the sum of 20 million, when the retained earning of the latter stood at 10 million. The statement of financial position of the three companies as at reporting date 31st December 2015 is as follows. So we have the statement of financial position as at 31st December 2015, Pali, Suzy, and Mama, everything in millions. Then we have a plant, you have PPE, Pali 300, Suzy 130, and Mama 80. Investments, Pali 180. Current asset, Pali 100, Suzy 70, and Mama 40. Share capital and reserves. Equity share capital at 1 naira per share. Mama 400, Suzy 120, and Mama 40. I think that's what I saw there. Okay. Then, sorry, can't see it again that much. What's happening? So I can't see the question again. I don't know what's happening in my phone.
Okay, wait. No, you see it now. Just wait. 1 minute.
Okay.
Can you see it now?
Okay, I can see it, but just one part. I can't see the left hand part.
Okay, just hold on. Can I see it better now?
I can see, but some parts are just cut off from my phone.
It's paused.
Okay, I can see it now. Yes.
Okay.
Yes. So I said then equity share capital at 1 naira per share. Mama 400, Suzy 120. Sorry, Pali 400, Suzy 120, and Mama 40. Then we have the reserves, retained earning. Pali 100, Suzy 60, and Mama 30. So current liabilities, Pali 80, Suzy 120, and Mama 50. So both total asset and total equity and liabilities is 580 for Pali, 200 for Suzy, and Mama 120. I think that's all.
Okay. Thank you very much. Now, what then do we need to do is for us to analyze one by one. What are we analyzing? Now let's pick it one by one, okay? Who is Susie to Pali? And who is Mama to Pali? From the information available, we are told that Pali acquired 80% in Susie. And with any other information which is not available now, we can make a conclusion that Susie is a subsidiary. Why? Because 80% should at least give control of the affairs and operation of Susie. That's number one. Number two, and that took place on 31st of December, 2013. Whereas Pali equally acquired 40% stake in Mama on 1st of January 2015. Now the issue there also presupposes that without any other information to the contrary, Mama will invariably be considered as an associate of Pali, given that 40% stake should at least give significant influence. Which then signifies that we have a subsidiary, we have an associate, and we have a parent. The first question I would now ask is that there is a group. How many members are in this group? Who can answer that? How many members are in this group? How many members are in this group? Who will answer? How many members are in this group? Who will answer?
It's 3 members.
In the group?
That's what I think.
Okay, what constitutes a group?
A group. A group is oh my word. I'm going to see. I think the group now is. I think a group is a parent, a minimum of 1 parent and 1 subsidiary. So I think it's 2. That group is 2. Minimum of 1 parent and 1 subsidiary. That should be a group.
Which means
So I'm
an
thinking it's 2 now.
associate is not a member of a group.
Okay.
Because group consists of the parent and all of the subsidiaries, and never will it consider associates or joint venture. Now, investments, the total investment of Pali was 180. And from the information here, it shows that this investment is the sum of the one incurred on Susie and the one incurred on what? Mama. Therefore, what can we do? Is for us to analyze the investments and say the investments, let me come to the side, working notes.
Huh.
Now my working notes. Note 1. Borders on breakdown of investments by Pali in other entities. And from the analysis and information provided, it has equity investment in Suzy. You also have equity investment in Mama. And we have described Suzy as a subsidiary. And we have described Mama as an associate. And what is the sum of those investments? The sum of the investment is said to be 180 million. Now, if we come back to this information here, they didn't give us how much was invested in Suzy, but there's a reference here that says Pali equally acquired 40% stake in Mama on 1st of January 2015 for the sum of 20 million, which means Mama was acquired for 20 million. That means that Suzy, investment in Suzy will be the balancing figure to make up the total investment. And that is the difference between 180 and this, which shows investment in Suzy was 160 million. Now, having done that, we can now come back to analyze, which is note 2, analyze our pre and post acquisition retained earnings or reserves. We have Suzy and Mama. Call Suzy the subsidiary. Mama is an associate. Now, what do we have? All figures in million. What are the pre-acquisition reserves? From the information here, as at 31st December 2013, when Pali acquired Suzy, the reserve of 40 million. We'll put 40 here. Whereas, as at the time Pali acquired 40% stake in Mama, the reserve was, in 2015, January, the reserve was 20 million. Therefore, what is our post-acquisition? is for us to ask ourselves, what is the reserve in the balance sheet? It's 60 for Susie, and it's 30 for Mama. And this is as at the reporting what? Date. (2015). Therefore, what is our post-acquisition profit? It's for us to look for the movement in that profit between the date of acquisition. One was 1st of January 2015. One was 31st of December 2013. The other was 1st January 2015, respectively. And therefore, what is the movement? You met 40 million positive, you grew it to 60 by 20. And likewise, you also grew 20 million of the associates by 10 to 30. Therefore, that is that, note 2. Now, I believe with respect to the fact that we have established that Susie is a subsidiary, therefore we need to determine goodwill, if any, in Susie. Cost of business combination. We have equity investments. If you remember, equity investment in Susie, how much was it? If you remember, we have analyzed it. And from the information here, it is 160. Therefore, what will I do? I'll link that to my 160. The portion that is left is non-controlling what? Interest, which we'll come back to later. I will come back to it once we establish what is the accounting policy on how non-controlling interest is measured at the acquisition what? Date. Now we compare this with the fair value of the identifiable net assets of Susie as at acquisition date. And from the left-hand side, or from the right-hand side, we have the share capital of Susie as at acquisition. And the pre-acquisition reserves. Now the share capital has not changed. That's 120. And the pre-acquisition is as analyzed above. That is 20. There I can make reference to say C note 2. Note 2. And this is not 1. Okay. Now, no fair value adjustment because the question only tends to test our understanding of associates. Therefore, what do we have here? We sum this up. And we have this. Okay. Sorry, I'm linking it wrongly. Pre is 40. Pre is 40. Okay. Now the next order for us is non-controlling interest. How is it being measured? We need access to note 3. Note 3. Therefore, come to note 3. Non-controlling interest at acquisition date. Now, the method where we are not given an option and neither do we have fair value is to adopt the proportionate share of the identifiable net worth assets of the subsidiary at acquisition date. As shown below. Now, what's the net assets? The identifiable net assets at acquisition date fair value was the sum of what we have here, which is the sum of this subject to adjustment, which we don't have any. And if that is the case, what is the Palace stake in the ordinary shares of Suzy at acquisition. That stake is 80%. I'll put it there, 80%. Therefore, you can now say value of NCI, which we are looking for. Equity attributable to non-controlling interest at acquisition. At acquisition will be the products, which means you are multiplying 160 with NCI is 20, not parent. NCI stake. NCI stake is 20 what? %. How do I have at 20%? The difference between the parent stake, let me put this parent stake there, so that everything is model. That's what I want to achieve. Parent stake is given to us, or sometimes we determine it. Parent stake is 80%. While NCI would be the difference between 100% and what? 80%. That's 20%, which means NCI is 32. NCI is 32. 32 is 30, that's 20% of 160. And in that case, I can rush down here to link it to say my NCI as measured as proportionate share is 32. And therefore, what is our goodwill? Goodwill at acquisition is the same thing that is on that. Why it's called acquired goodwill. Because our acquired goodwill. That's 32. These are goodwill. Now, is there impairment? We deduct impairment loss if any, but I don't think the question has impairment loss. But let me show you here by way of template on goodwill. I think in this question there is none. Zero. There's none. Therefore, what you now have is what we call consolidated goodwill, or simply put, goodwill as at what date. Okay. That's that. Now that means our goodwill is 32. We can come here and show our goodwill under non-current assets. That's I can call that notes 4. $32. Okay. Now, what next? Is for us to account for equity method accounting for investment in associates. What's our associate now? Mama. As at the reporting date. I'll call that note. That's note 5. Okay, in doing that, I need the cost of investment, which is equity investment in associates, and that was 20 million. I need that 20 million. What do you add? You add share of post acquisition profits. This share you are adding is the product of your stake in associate. What's our stake in associates? Let me put it somewhere here. Multiply by our post-acquisition profit, which is 10, if you can remember. Now, let me just put my stake here in associates. I put it in this box. And what percentage was it? 40%. Therefore, which means 40% of 10 million is 4 million. Okay, that is that. Now, we don't have dividends, we don't have impairment loss on associates. Therefore, I can sum that up to determine my carrying amount as at 31st December 2015. And what is the accounting entry we need to pass to recognize this share of profits? Our accounting entry is to increase the investment and credits our profits, which invariably is consolidated into the retained what? Earnings. And therefore, That is the 4 million. Okay. All figures a million. Now that is that. Now, what that means that we can come here to show our investments in associates. Okay, I'll leave this first investment. I'll come here, investment in what? Associates. Not 5. That's 24. Okay. Now, what is next is to consolidate our retained earnings and the value of NCI. Let's obtain our consolidated retained earnings and non-controlling interest value as at the reporting date, that's December 2015. That's note 6. We have consolidated retained earnings, our CR and NCI, non-controlling what? Interest. All figures in millions. Okay, now what do? We first of all bring in the reserve of the periods. And the reserve of the parents, which is in our balance sheet, was 100. Next, we bring in the NCI, value of NCI as measured at acquisition, which you can refer to note 3. And note 3. $32. Next is the share of post-acquisition profits of Suzy, which is the subsidiary, and you share that in what ratio? Ratio 80-20. Since the parent owns 80, and therefore, parent take 80%, We had 80% somewhere, yeah? Of how much? Of the 20. 8% of the 20. 80% of the post-acquisition reserve of subsidiary. Why? The NCI would take 20%. This 20% of the 20. That's 4. The next is for us to recognize the parent share of post-acquisition profit in MAMA. MAMA in this case is an associate. And an associate, there's no NCI involved, and therefore you only take 60%, sorry, 40%, which is your stake in the reserve. The post-acquisition reserve here, if you remember, was 10. Okay, and this 10, applying that 40 is what gave us this 4. Therefore, I'll come here plus 10 million. Which we already have. I can easily link it to what we have before, which was this form. Okay, no other adjustments. At the end of the day, we sum this up. We have 120. And here we have 36. Okay, which means I can come here, my consolidated reserve. CNOT 6. That's 120. Those things in red are things derived. Okay, non-controlling interest was 36. Now remember, share capital will be the parent only because we've canceled out upon consolidation here that of the subsidiary as been cancelled. Therefore, the parent only, you must emphasize that, take note of it. And that is how much? That is 400 million. Therefore, I can sum this up and my total equity. Okay. Now we could go back to other items like PPE. What is my PPE? My PPE for Pali is 300. My PPE for Susie is 130. My PPE for Mama is 80. But you must take note of something before I proceed, that Mama, let me borrow something here. That Mama will never be consolidated. Who can tell me why Mama will not be consolidated? Therefore, I put this arrow to signify that I want to cancel it out. Who can tell me why Mama will not be consolidated?
It's because we don't have control over Mama. Pali does not have control over Mama.
Yes, you only account for your own equity stake in Mama, which is what we are trying to do. Therefore, I won't consolidate this in any respect, which means my PPE to be consolidated is that of the parent, which is 300, plus that of subsidiary, which is what? 130, subject to any adjustments, which in this case, there's none. I can come here and say the sum of just the parent and the subsidiary. Now, I have investment before. My investment before was 180. I'll put it there, 180. Upon consolidation of Mama, of Susie, which is subsidiary, remember I canceled out 160, which was investment in Susie. Therefore, that has gone out. Also, in the process of equity accounting, I've already taken away this 20 also. At the end of the day, once I take away this 20, what is left is 0. It means 180 minus 160 minus 20 will give me nothing. Why I'm emphasizing this is that peradventure tomorrow, this is not 180. It now becomes 190. What you find here is 10, which means you have other investments. You have other what? Investments with third what? Parties. And that is what it means. That's what I was trying to explain. Okay, let us take note of this. Okay, let me return it to that. Now, the sum of my non-current assets is 486. Now my current assets, I have 170. Subject to adjustment if any, 170. That's 170. Okay, now my current liabilities. What do I have? My current liabilities, I have 80 and 20. $80 and 20. I have that. Therefore, I can consolidate this, sum it up, and have my position. Okay. Any question on this? Any question on this? Now, this is our results. Now, this is the system you use to account for your equity stake in an associate. You don't consolidate an associate. Your equity account for your stake in associates. Any other question? You've seen our working notes?
Okay, we're done.
Yeah, and this is what you also demanded for, that you want to see how you can use Excel to do consolidation.
Good question,
Yes.
but
Yes.
I just get clarification to where I made error. I mistakenly consolidated. I consolidated the investments and associates. That's the mistake I made.
Thank you for, now you can appreciate it better now. If you have not attempted it on your own, you might have seen it as much easier than you have seen it now. You understand? Yeah. And that's the beauty of you trying to do something and you get corrected rather than just seeing question and answer. Any other question? Now, the same thing we've done here, we are going to replicate it for this question. That is from the income statement side. Okay, I want somebody to also try and read this. I want a lady to volunteer now. Anne, are you there?
Yes, I am. Good afternoon.
Okay, can you assist us to read this?
Okay, but it's quite tiny.
Tiny? Okay, what I'll do is that let me go to
yes.
Let me share the text.
Okay.
Let me share the text so I can enlarge in that. Okay, proceed.
Okay. Illustration 4. Arsenal acquired 80% interest in the equity of Chelsea as January 1, 2014, when the retained earnings stood at 20 million naira. Arsenal also has an investment in Barcelona, which gave it a stake of 20% in the equity of the latter, and the retained earnings of Barcelona stood at 5 million naira upon acquiring the stake. The board of Arsenal strictly wants to comply with the requirements of IFRS regarding consolidation of the financial statements of the subsidiary with that of the parent as at December 31, 2016. Income statement for the year ended December 31, 2016. Revenue for Arsenal, every figure in million, 600 million. Chelsea 390 and Barcelona 100. Cost of sales 345 for Arsenal, 201 for Chelsea, and 80 for Barcelona. Gross profit 255 for Arsenal, for Chelsea 189, and for Barcelona 20. Distribution cost 75 for Arsenal, 45 for Chelsea, and 2 for Barcelona. Administrative expenses 105 for Arsenal, Chelsea 90, and 6 for Barcelona. Profit before tax 75 for Arsenal, 54 for Chelsea, and 12 for Barcelona. Income tax 25 for Arsenal, 29 for Chelsea, and 4 for Barcelona. Profit for the year 50 for Arsenal, 25 for Chelsea, and 8 for Barcelona. Movement in reserves. Retained profit brought forward. We have 120 for Arsenal, 65 for Chelsea. Please can you scroll up? Okay.
Okay, continue.
Okay. Required. Okay, required. Prepare the consolidated of profits or loss and the consolidated statement of changes in equity, given that the share capital of Arsenal stood at 200 million naira and that of Chelsea amounted to 100 million naira, and the amount of non-controlling interest at acquisition as measured at fair value stood at 24 million naira. In this context of this text, in this context of this text.
That's all.
Oh, okay. Okay.
Yeah. Now let's try. Who can give us clue about what is required of us here? Who can give us clue? How will you attempt solving this question? What is required of you?
Okay, good afternoon. So in solving this question, the first thing is that we parent at the subsidiary, as in the income statement, consolidate the income statement. Then we now, in the statement of changes in equity, we account as part of the parent retained earning. We account for the post-acquisition earning of the associates. Then we also, in the statement of the income statement of the consolidated income statement, we also account for the current year's income, the parent portion of it from the associates. I think those are the things that I need to take into consideration.
Okay, who else? Who else? Anne, you read the question. Give us a clue.
So I don't have idea, but I don't know what to, because I haven't watched yesterday's video, but I'm just trying to understand even the topic that we are even treating. So I don't have any clue to give.
Okay, Mr. Adebayo.
Yes, sir. Just to support what Enaru already said, this is, we are required to prepare the consolidated profit or loss. You know, we could see that Arsenal has 80% investment in Chelsea, 80% interest, and that means that Chelsea is a subsidiary and we are going to consolidate. And it has just 20% in Barcelona. So because of that, there's no control. We won't be able to consolidate. We'll just account for the investment in Barcelona using the equity methodology. So that is just basically what we are meant to do, and we'll prepare the consolidated income statement and statement of changes in equity.
Okay, now let's try and solve the question now. Okay, now we've populated in our consolidation schedule the result of Arsenal, Chelsea, and Barcelona, respectively. Okay, now how do we proceed to consolidation? Is that first, you must know, and that's why I kept this arrow, that you don't consolidate the result of an associate. Therefore, even though it's contained in my schedule, I'm going to cancel it out. And you find out that before adjustments, which we'll look at, if any, you find out that the sum of these three lines does not sum up to this. Why? Because if you click on here, you'll find out that what I've only summed up is the parents, the subsidiary, and the adjustments. Why? Barcelona, which is an associate, will never be consolidated. Now, if that is the case, what then are we going to do? Is for us to account for our share of profits after tax in Barcelona. Therefore, I'll come in, working notes, yeah. Share of profits after tax in Barcelona. And Barcelona is what? An asset. Now, the first thing is, what is the profit of Barcelona in that year after tax? The profit of Barcelona in that year after tax is 8 million. Okay. Now, I'll come here and say, Barcelona profits for the year. Usually, after what? Taxes. How much is it? That is the 8 million here. Remember, all figures are in thousands of naira. Now, that's the first item there. Now, what is the stake? Arsenal stake in Barcelona is what percentage? Barcelona, we gave a stake of 20%, 20%. Therefore, what will now be the share of profits? Share of backers, which is associates, profits after tax. It will be the products of 20%, 8 million, which is 1.6. That is that. Okay, which means we'll come here as part of our other income to recognize share of associate profit after tax, which in this case, we'll pass it as an adjustment. It increases the profits, therefore it's a positive adjustment. Because this adjustment, if you are preparing the balance sheet, the accounting entry will have been debit the investment in associates, which is Barcelona, and credits our two profits, which is what we've done here. With how much? With 1.6. That credit is what you are seeing here as credits. Okay, at the end of the day, I'll come here, share of backers profits, associates for the year. That's 1.6. That is that. Any questions so far before we proceed? Any questions so far before we proceed? Any questions so far? Anyone trying to contribute? Okay, in the absence of no question, now this is how our consolidated profit or loss will look like, where we have to link admin expenses, perfectly. And here, the only thing that is new here is other income, share of asset profits, which I can easily link to what I have here as 1.6. At the end of the day, what you have after consolidation is 76.6 million, which is attributable to owners of equity of the parent of 71.6 and non-controlling interest of 5,000. And how we obtain that is from these adjustments that we have passed here. Any other question? Now let's see our statement of changes in equity. Our statement of changes in equity, remember, as earlier populated, what will be the difference? The difference will be in how we determine our opening balances with respect to, this is note 3. How we determine our opening balances with respect to consolidated retained earnings and with respect to NCI, non-controlling interest. Now, what is new here, okay? This is what we have before. Subsidiaries retained earnings brought forward was 20 because that subsidiary, we're told, when it was acquired, the retained earnings was 20. Okay, likewise, the subsidiaries retained earnings brought forward is 65. Parent retained earnings brought forward was 120. Non-controlling interest at acquisition was measured at fair value of 24. These are the information here. Now, what is now new to it is that we also now bring in associates. Now, what is the pre-acquisition retained earnings of associates? Come back here, we are told that when asset was acquired, the retained earnings of FICA, which is the associate, stood at 5 million. Therefore, I'll come here and say 5 million. I'll use that information where it's relevant. And secondly, the retained earnings brought forward for associate was 9 million. I'll also bring it here, 9 million. Now, similar to what we did for subsidiary, where we share the percentage relevant to parents and the percentage relevant to NCI, which is 80 and 20 respectively, we use that as a basis of sharing the post-acquisition retained earnings brought forward by the subsidiary. And that is the retained earnings of the subsidiary brought forward after deducting the pre-acquisition profit or loss. The same thing we did for NCI. Now we are going to replicate exactly the same thing for associates. But what is the difference? Instead of now referencing the word 80%, it will be 20% is what the parent has at stake in the associate. I'll change subsidiary associate. Okay, and that is it. I come here, 20%. That is the stake you have in the associates. Okay, NCI has no business with the associates because NCI has no stake in the associates in this case. Therefore, what I'll do is to find 20% is the parent stake, which we have somewhere here. Where was it? Yeah, this is 20% in Barcelona. We multiply that by the difference between the retained earnings brought forward and the pre-acquisition retained earnings. So that what you only consolidate from the perspective of the investor is your post-acquisition profit in the associate. And which means, what is your post-acquisition is the difference between 9 million and 5 million, which invariably is 4 million. 20% of 4 million will give us the 800,000. And that gives us what we should have as a consolidated retained earnings brought forward, which is what is populated there. Likewise, our NCI remains unchanged because NCI has no stake in an associated company. Okay, because you are not even consolidating the associate, you're rather accounting for your equity stake in that associate. And that brings us to that position. Any other question? Any other question?
So for me, it's very clear. I don't have any question.
Okay.
Okay, so for me, I understand what you explained. Thank you very much. So basically, for the associates, we consolidate. I mean, we do it the way you say we should do it, as in we take cognizance of the post-acquisition profit and also the current year profit in the consolidated income statement. Then, so we are, I mean, account for it using the equity method or the fair value method or the cost method, cost in investment method. But if it's not an associate, that's when we begin to use the fair value method of fair value through profit and loss as we categorize as the financial asset. I think, hello?
I think you are missing it.
I just, no, if if I have shares,
yeah.
yes, if I have shares in a company that is just an investment, that is a financial asset. I have shares in a company, either whether I want to hold it to, based on the categorization that you explained to us then, the
Yeah.
financial asset. That is, so basically, we can categorize it as fair value, as a financial asset through, through profit or loss or through OCI. I think
Yeah.
in the case of associates, we use the equity method, provided it has reached the 20% threshold. I think that,
Yes.
am I in order?
Continue.
So basically, for the associates, which is the 20% threshold up to 50%, at what point do we, basically the standard, we are looking more at equity method. And based on what you said, if we don't have much information, we can use the cost method. So at what point do we use either of these three, equity method, fair value method, and the cost method for the investment in associates? Just briefly, yes.
Okay, let me show you this. Remember that first, before you even talk of subsidiary associate joint venture, you must first of all recognize that you are investing in shares, in equity. And equity from the perspective of IAS 32 is a financial asset. When you invest in the equity of another entity, is a financial asset. Okay, and by default, equity investment that is considered to be a financial asset must be measured at fair value. That's the position. Okay, it's now left for you based on certain conditions, whether it is measured at fair value to profit or loss or at fair value to OCI, but all equity investment must be measured at fair value. That's given. Now, we are not saying that there are some equity investment that goes beyond just financial assets. There are equity investment that goes to the extent of giving you control. There are equity investment that goes to the extent of giving you significant influence. There are equity investment that give you to the extent of joint control. Therefore, we are now saying that how do we account for this? We account for them on the following premises. Okay. Now, we are strictly talking about associates in this case. Now, if we go back here, I said, we now need to understand what form of financial statements are we talking about. If you go back to the beginning of this class or of this workshop, we had discussion on conceptual framework, where we define various forms of financial statements, starting from issue of combined statements, single statements, consolidated statement, and etc. Now, in this case, we are saying that for the purpose of trying to explain this, we have three kinds of financial statements. The first one is a separate financial statement. The second one is the consolidated financial statement. And the last one is the financial statement. Now, what distinguishes them from one another? The first two has relationship. Separate financial statement simply means financial statement of any parent entity other than its consolidated or group account. And it means that it's only a parent company that prepares group account that can vividly confirm or say that its financial statement is a separate financial statement. Whereas consolidated financial statement is a separate financial statement of the parent that is combined in line with the requirement of IFRS 10 with that of the subsidiary. Okay, that's what I mean by consolidated financial statement. And the last one is the individual financial statement. Simply put, financial statement of a single entity that is not a parent to any other entity. Now, the question then is, if you are a parent entity, in your own financial statement that is deemed to be separate financial statement, you are to adopt cost method or at least fair value method in line with IFRS 9. And the exception of using cost is only by way of IAS 27. And that exception is strictly applicable to a parent entity that prepares group accounts separately from its financial statements. Secondly, if you prepare group accounts, if you have an associate, you are to account for it using equity method and not fair value, which means any fair value you have done at your entity level will be reversed and substituted with equity method, which is what I showed you yesterday, which is this that I showed you yesterday, where you have measured as fair value and you have to revert to your cost at every point in time.
Yes.
Okay.
Yes.
And lastly, if you are just a company on your own, and I use Fibonacci Green Finance Operational Services Limited as an example, where you have investment in a company that qualifies as your associate due to the fact that you have significant influence. In that instance, you can only use equity method and not fair value, provided evidence shows that you have a significant influence in that entity. I think that's explain what you've asked better. Any other question?
Okay, thank you.
Yes. Any other question? Any other question? It seems you guys are quiet. Any other question? Okay, if there's no question, let me give you a teaser here. Let me give you this question. I want you to read it and let's see what happens. What I demanded first is explanation. Okay. Who can read for us?
Illustration 5.
Yes.
Okay. Illustration 5. The statement below represents the draft account of Alpha and its subsidiaries and of Gamma Alpha acquired 30% of the equity capital of Gamma 3 years ago, when the latter's retained earnings stood at 10 million naira. Statement of financial position as at 31 December 2016. Property, plant, and equipment. Alpha and its subsidiaries. Every figure is a million. Alpha and its subsidiaries, 200. For Gamma, 120. Investments in Gamma at cost, 50. Loan to Gamma, 30. Current assets. Loan from Alpha, we have 30. The total asset for Alpha and subsidiaries 400, and that of Gamma is 180. Equity capital at 1 naira per share. For Alpha and its subsidiaries 250. I can't see the other one. Retained earnings for Alpha. I can't see. No, I can't see the figure for Gamma. Equity capital for Gamma. Can't see.
It's there now. It's 100. I can see it.
Okay.
Check. What's it?
Equity capital. Okay. Yeah. Okay. Alpha and his subsidiary is 250. Then for Gamma, 100. Retained earnings 150 for Alpha and subsidiaries and 80 for Gamma. That's all.
Okay.
Okay.
Continue.
Statement of Statement of profit or loss for the year ended 31 December 2016. Profit before tax, Alpha and its subsidiaries 80, for Gamma 60. Income tax expense 30 for Alpha and its subsidiaries and 20 for Gamma. Profit for the year 50 for Alpha and its subsidiaries and 40 for Gamma. You are required to prepare a draft consolidated account of ACCA FC at 31 December 2015. I think that's all.
Okay. Therefore, I need guidance on the question. Who will guide us? Who will guide us?
Okay, I think what I see there is like, okay, the considered statement account of Alpha. So I'm saying that I think it should be Alpha. Then for me, I think for us to, the account is, it looks like it is consolidated because it's Alpha and its subsidiaries. So I don't know how you could consolidate this since Gamma is an asset and is already combined, that of Alpha and its subsidiaries.
I can't hear you again.
Except we want to prepare, incorporate the element of profit, post-acquisition, retain any of profit and loss. I think that is, can't see anything that much from our end.
Okay, who else?
Okay, from my hand, I also believe that, you know, the Alpha and its subsidiaries represents a consolidated account, while Gamma is the investment in associates, which is that 30% that Alpha owns in Gamma. So what we need to do here is just to recognize the investment in associates, and we also need to recognize the share of profits in associates. And I think that is basically what we need to do. We follow the same pattern that we've been doing before. So that's just all.
Okay, who else?
Okay, based on the scenario on the screen, I think basically what we are meant to do is to account for investments in associates. That is, Gamma as associates to Alpha and its subsidiaries. Okay, we are to check the share of we are to check the share of profits, especially the profits associated to Alpha and its subsidiaries and investments and associates. And we are to prepare a draft statement of financial position. But basically, we are not meant to consolidate the position of Gamma in the statement of financial position. Rather, we recognize only the profits associated to Alpha and its subsidiaries. Thank you.
Okay, who else? Who else? Okay, now we'll try and solve this question. But let me give you a clue first. The clue is that they've already prepared group accounts, but that group account seems not to be correct because it's incomplete. Why is it incomplete? Because there was a stake in an associate that was not yet accounted for properly. And therefore, if that is the case, what are we supposed to do? How do we account for it? What should we do now? Who will assist me?
We use the equity method to account for investment in Gamma. That's what I see there. And then for the statement of profit and statement of financial position. So use the equity method.
Okay, now let's try and do that. Now, this is a question. Now we can see the question at a glance now. Now, what has happened in this case is that Alpha and its subsidiaries account has already been consolidated. Where you see this, or you see Alpha Group, you know they are talking about consolidation. This is the combined results. Okay, but you observe something here, that here, investment in Gamma was still carried at cost of 50 million. Okay, and Gamma was acquired 3 years ago when the reserve was 10 million and the stake in Gamma was 30%, which ultimately made Gamma an associate. Gamma is what? An associate of Alpha. In that light, what do we need to do? And they gave us the extract of the group and also of Gamma with respect to profit or loss. Now we are told to redraft our consolidated accounts. And to redraft the consolidated accounts of Alpha, not Arsenal. Alpha. Alpha Group. Okay. Now, what then do we do? Is for us to harness our understanding here that says that at consolidation level, what we should use is what? Equity method and not cost. Cost is only at the separate financial statement level. Therefore, this knowledge here is what we bring to bear here. And what then do we need to do? Is to try to reproduce the accounts What can I do here? Let me borrow something from here. To create my templates. Okay, what are the information I need here? Property, plant, and equipment. Investment in Gamma. There's loan. Long-term loan to Gamma. Okay. Current assets. Share capital. Retained earnings. Okay, that's all what I have there. Current liabilities. Okay. That is that now. That'll be my final results. But what was given to me this is not there. I want to replicate this so that I can link it. Current assets. Loan from Alpha. That should give me my net assets. Okay, I have alpha. And I have gamma. All figures in millions. Okay. Now I bring those figures in. 200, 50, 30, 120, and here 120. This is 60, not 30, and this minus 30. Take note of that. This is not 30, this is 60. This is 60. Take note. And this is liability in bracket. And that's what I've done there. Okay. Now share capital. What was there? 250 and 150. And this is 100. And 80. Sorry, this 90. Okay. Now, this is a position now. Okay, and they also give us for profit or loss. Okay, for profit or loss, the information given to us is just average. Is extract. It's not complete. Therefore, we'll pick the same information. Profit before tax. We have our income tax expense. And we have our profits for the year. What's our profits? 80 and tax 30. What's our profit? 60 and tax 20. Okay. Now we've had that. Let's now start our consolidation process. We've consolidated before. The only thing we then need to do is to borrow a leave from how do we account for our investment in an associate. Now, I did that somewhere here. Therefore, I borrow this information here. That probably will be my working note 1. I come here to borrow that same information. Now I need my cost of investment in gamma. Okay. And the reporting date in this question is when? 2016. Now, what is my cost? What is my cost? My cost is 50 million. Yeah. Okay. Now, what is the stake I have in gamma? 30%. Okay. What is my share of profit in gamma? I'll ask myself, what is my post-acquisition profit in gamma? Now, I'll borrow something from here. This information here. Okay, what is the pre-acquisition retained profit in the associate? When we bought the associate 3 years ago, it was 10 million.
10 million now.
Okay, 10 million. Every figure is in thousands. Remember? Okay, and what is the retained earnings brought forward? We are not given the retained earnings brought forward. We are given only the retained earnings carry forward, which is ACTI.
Yes.
Therefore, I'll change this to carry forward. They didn't give me the opening, they gave me the ending. Therefore, I need the opening. But I know that the difference between retained earnings brought forward and carry forward is what? Who can tell me? What's the difference between the two? What comes in between the two?
It's profit for the year.
Profit for the year. Are we giving profit for the year?
Yes.
Yes. I'm giving profit for the year to be 40 million. Abi? Therefore, I'll say associates profit for the year. I was given, Abi. I was given retained earnings at the end of the year is 80. Every figure is in millions, sorry, not in thousands. In millions. Associate profit for the year, also in millions. Is how much? How much is that?
40 million.
40. Therefore, retained earnings is 80 at the end. Profit for the year is 40 million, which then means that this is what we are now looking for. I'll put it in red because we are not given. Now, who can tell me what will have been our retained earnings of the associate brought forward? If the retained earnings carry forward is 80 million and the profit for the year is 40 million, what will have been the opening retained earnings?
40 million.
40, which is the difference between this 80 and 40, which means you started with 40 balance and the 40 million you made during the year add up to that 40 to make up 80. That is that. Remember, let me put it there. Derived. We derived it. It was not given to us on a platter of what? Gold. Now, what else do we need to do? We then need to determine what goes into our group reserve from the balance sheet perspective. And that is how much. We now need our post-acquisition profit. What's our post-acquisition? This is pre-10. What is our post?
It's not 70.
Our post-acquisition now. As at end of the year. Is how much?
70.
70, which is the difference between 80 and 10. Therefore, what percentage are we looking for? We are looking for the 30%, which is the stake we have in that 70 million. What is that? Who can give me the value? %30 of 70 million is how much? 30% of 70 million.
21.
21. Therefore, this is our balance sheet, which means if we reconstruct our balance sheet, so if we reconstruct our balance sheet, what will be our PP? Who can give me the amount our PP will be now?
200 million.
Why not 420, 320, 200 plus 120?
Because you are not consolidating Gamma.
Which means it's still the 200 million. Gamma is not consolidated. Remember the arrow I gave you the other time. Let me borrow these two arrows and insert it on Gamma. That means what are you consolidated before is what you need. You don't need Gamma asset and liabilities, 200. Investment in Gamma, how much is it now? Which is same as investment in associates. How much is it?
It's going to be 0.
No, investment in Gamma is not 0, is that 71? Is that not the same amount? Sir? Why is it 0? it's no longer 50. It is now 50
71
plus 21.
71, yeah.
That's it. And what note is that? That's note 1. That's where it came from. Now, loan to Gamma, that one is still there as long term. This is a financial asset. How much is that? 30. That is that. What's our current asset? What's current asset? Our current asset is 120. Everything is 421. Share capital, it will be for alpha only, which is still the same thing we have here, which is 250. And our retained earnings is no longer 150. Remember, there's an adjustment to it. This note 1. Note 2. Consolidated retained earnings revised. As at 31st December 2016. Now, consolidated retained earnings before accounting for share of associates' profits. That was the 150 we have, this 150. It was consolidated before accounting for share of asset or profits. Now, we now account for share of what? Asset profits. Therefore, let me just click this. Note 1. How much was it? 21. Now remember, they said debit investment in Gamma, which is what brought about increase here, which you can also see here. This 71, sorry. And the corresponding credits is to retain what? Earnings, which is what we've done here. Now, net, what is our revised consolidated retained earnings? That's 171. We'll come here. See revised note 2. Okay, that is that. I'll link that to my note 2 and have 421. Okay. And that is that. At the end of the day, you find out that we are not consolidating the asset or liabilities of the asset or liabilities of the associates. Any other question?
You're muted, sir.
Sorry, the network went off, and when it came back, I didn't know that I was muted. Sorry. I said now we are to do the revised consolidated statement of profit or loss. Now, to do that, I said since we are given the abridged, account that started from profit before taxes, I said from the group perspective, this is not the profit before tax because it did not take into consideration the share of assets profits. And from the presentation of financial statement in line with IS1, share of asset profit is integral in arriving at profit before taxes, which means what profit you have is probably the operating profit from the day-to-day business of the group, which is from the subsidiary and the parent, which means this 80 million that is termed profit before taxes was supposed to be the operating profit of the It is then we'll now add to that the share of associates profits. And asset profit is always after what? Taxes. And therefore, that is what is missing in there. And what we have to do is to ask ourselves, what is the asset share of profit for the year? Now, in that year, the profit was 4 million. Therefore, note 3 is share of associates profits for the year. Now, asset profit for the year is for us to go back. The asset profit for the year stood at how much? 40 million. Now, our stake in associates, if you remember, is 30%. Therefore, our share of profits after tax in associates. Remember, profit or loss deals with each period will be that 30% multiplied by the 40 million. And what is that? The product of the 30% and the 40 million will give us 12. Now this 12 is what we recognize here as share of associate what? Profits. Not 3. Because primarily, if you remember, the entries we pass, which I'll show you, we are adding it because it's a profit, share of profit. If the loss, you deduct. Invariably, our profit before taxes in the group is now 92, as opposed to 80 we had before. And our income tax of the group will be income tax as already consolidated. And at the end of the day, our group profit for the year stood at 962. And these profits, based on our tradition, have to be attributed between non-controlling interest and NCI. But in this question, there's no non-controlling interest because the parent is own the subsidiary under what? Percent. Okay, which means in this case it is a 0 for non-controlling interest. It then means that every other balance belongs to the parent. And that is that. NCI is 0 because this subsidiary that was already consolidated is wholly owned subsidiary. Now, this is what our group profit or loss is for Alpha Group. Now, how will our statement of changes in equity look like? Invariably. Let me borrow something from here. Can put somewhere here. Okay. Let me just borrow this side. Okay. Now we'll come back to this. Now, what is the share capital? The share capital is 250. Come here, 250. Remember, all figures are in millions. Our opening retained earnings is what we need to determine. Okay. As usual, remember, we did something here, which we'll borrow the templates. Okay, but this will not be required for the subsidiary because that has already been consolidated. What is now left for us is that of the associates. Now this is already consolidated. I won't use the word parent, I'll use the word consolidated. Okay. And that's refer to note 5 will guide us to determine that. But the one we are doing now is note 4. Okay, what is note 5? Note 5 is to assist me. This is revised. Now, note 5 is to assist me to get this amount ab initio. And you are going to see the reason why we are doing that. Now, if we go back to the question, the consolidated retained earnings is already 150. Okay, having consolidated this 50 to make up 150, which then means that this consolidation that was done that excluded the results of associates How do we obtain that? This is figures in millions. How do we obtain it? Now remember the relationship we did here. Let me circle it. What we did here with respect to the associates, That's opening retained earnings brought forward, derived at this point. Similar thing is what we're going to do, where we'll compare the consolidated in this case to say, my consolidated retained earnings brought forward and my consolidated retained earnings carried forward. The difference between the two is my group profits. It's my group profit attributable to the parent. In this case, alpha. And therefore, the difference between these two, our consolidated retained earnings, which already was consolidated, was 150, which was balanced at the end of the year. Our profit already consolidated was 50. Therefore, this will be the derived figure. What will have been our opening balance such that when we added our share of profit from the group perspective in the year gave us 150. Therefore, this is derived. And that means 150 minus 50 will give us what? 100. And in that light, we are able to obtain this amount to say our consolidated retained earnings brought forward before including result of associate was 100. And therefore, I can easily trace that back here, which I said is from note 5. Now, doing so, I needed to share 30% stake of the parent who is an investor in the post-acquisition retained earnings brought forward for the what? Associates. I remember what is the result brought forward for the associates. The associate has carried forward, this is a brought forward for the associate, 40. Now, out of this 40, there is a pre-acquisition of 10, which then means that also here, I can determine, which is note 6, my post-acquisition retained earnings for associates, in this case, gamma. And that is as at 1st of January 2016, which is the same thing as 31st of December 2015. How do I determine that? The same thing we've done here, instead of using consolidated, I'll just change the word to gammas retained what? Earnings. Gamma's profits for the year. And gammas retain what? Earnings. Okay, what is gamma's profit? It was 80. If you check here, 80. What is the profit for the year? of Gamma. Profit for the year for Gamma, if you come back here, is 40 after tax. It then means that Gamma's retained earnings brought forward is 40, which is the same 40 we have here. Now, what I now needed is, I need the post-acquisition. I'll now say this 40 ends the post-acquisition retained earnings for Gamma, which is as at these dates. Let me copy it. Is as thus. Therefore, it will be this my Gamma retained earnings brought forward that I've just derived. Remember, I derived it because I'm working back. The information was not given to me on a platter of gold. I will now deduct my pre-acquisition retained earnings of Gamma. What is the pre-acquisition retained earnings of Gamma? Remember, pre-acquisition retained earnings of the associate Gamma was 10. Therefore, that 10, once I deduct that, it gives me 30. That 30 is my post-acquisition. And it is from this 30, which is note 6, that I'm going to recognize here. Which means what I have here, in this case, is now 30% of 30 million. See note 6. How do I have at 30 million? That's what you see in note 6. I'll now come here, the 30%, which is what I have here. Remember my 30%? Note 6 gave me this 30. And that is my 9, which means I have 109. And this 109 is the revised consolidated brought forward, which I'll link here and say 109 is my consolidated retained earnings brought forward. Now we don't have NCI, I'll just put 0. Now the profit that we have attributed to the parent is 62, and we have attributed 0 to NCI. Okay, at the end of the day, you find out that our share capital is 250, our consolidated retained earnings is 71, our equity attributable to the parent is 421, NCI is nothing, and equity is 421, which tied to what we have here as 250 and 171. Does that make sense now? Does that make sense to us?
Yes, sir.
Yeah. Any other questions? Any other question? Now, what I've just simply shown you is how you more or less adjust for what has not been taken into consideration. And what we have done first is to consolidate, to account for associates using equity method and revisiting our consolidated financial position. And that's why I should emphasize it here that it's a revised account. Already it has been consolidated before now, but they omitted equity accounting for the associates. And that's what we did here by increasing the investment in associates and increasing our consolidated result with the share of the associates profit. And in the consolidated statement of profit or loss, we considered the initial profit before tax as an operating profit from the group perspective until we recognize the share of asset profit before we can arrive at the profit before tax in the group. And the income tax of the group is solely what was consolidated earlier as the income tax of the parent and that of subsidiary is subject to relevant adjustment. Since there is no non-controlling interest, all of this profit is attributable to the parent. Since all of the interest in the subsidiary was only owned by the parent, according to information provided. Now, the equity method is what we've done here with relevant information and how we are able to carry out necessary adjustments. And we had about 5 notes or 6. Note 1, this with accounting for equity interest in the associates. Okay, the asset in this case is gamma. Let me correct that. Okay, and after that, we also look at the notes that assisted us to determine the consolidated retained earnings as at the end of the year. Okay, we also look at the note that allow us to determine the share of asset profit for the year. Okay, and note 4 assisted us to determine the consolidated retained earnings brought forward. Okay, prior to, okay, that's at the point of revision. Okay, and note 5 is consolidated retained earnings brought forward before the revision or before the asset was accounted for using equity method. And note 6 is where we are able to get a clue towards obtaining what will be relevant for us in note 4, okay, which is our gamma's retained earnings brought forward to be able to ascertain our share of post-acquisition retained earnings of gamma as at the beginning of the year. Okay, that is that. Any other question? Okay, in the absence of no question, I think this has brought us to a conclusive position on investment in associates. If there's no other question,
I have a question was not directly related to what we are treating today.
Okay. Does it relate to associate at all?
No.
Okay. Okay. Before that, let us conclude this before you ask that question. Okay. Now, this is all what we want to discuss on assets. And I'm going to close it up with some brief discussions on, let me share my notes. Yeah, that is on other critical adjustment that might arise from accounting for your stake in an associate. Okay, let me share the notes, the text with us. Okay, the following are critical adjustments that might come across. The first one is issue that borders on uniform reporting dates. Similar to what we've discussed in group account, the parent or the investor and the associate are expected to have uniform reporting dates. That is the same reporting dates. Okay, but where practicable, they don't have the same reporting dates, it should not be far apart beyond 3 months for you to appropriately account for your equity interest or equity investment in an associate. Similarly for a joint venture. Therefore, if it's more than 3 months, necessary adjustment to reconstruct the account will be necessary. And even within 3 months, material transactions should be adjusted for. That is the first one. The second one is that accounting policies of the subsidiary of the associate should also align with that of the investor, which is the parent in this case. Treating the group account, that is for the subsidiary. Okay, which means the same principle that applies to the subsidiary also applies here, which means the accounting policy of the parent and that of the associate must be the same or should be the same. And where they are not the same at the entity level, at the point of preparing the account where you incorporate the result of the associate, you must adjust for it as appropriate. Another one is issue of downstream and upstream transaction. Downstream transaction is where the investor, which is a parent in this case, is the one that sells goods or transfer assets to the associate. And what we are saying here is that if we are to eliminate the unrealized profit in that situation, such elimination will be between the cost of sales, which is within the profit or loss of the investor, and the investment in associates. Okay, and where there is excess depreciation arising from the transfer of assets, which does not apply to sale of goods, you'll find out that the adjustment also will be to reduce your investment in an associate and increase and also adjust by reducing the effect of that on your cost of sales. And that is the first two adjustments you see here, dealing with downstream transaction. But if it's an upstream transaction where it was the associate that sold goods or that transfer
Hello? Hello, Shegun. Hello? Hello?
I can hear
Hello,
you.
Shegun, can you hear me? Okay, so I think we lost connection from you.
Yeah, I'll
Probably it's
probably
trying
is
to
going to
log
join
in
us
or
later. He'll find a way to connect back.
I think so. But it's not there at all.
Hello, guys. Can you see my screen now?
We can see your screen.
Okay, sorry, my two sources of data went down. Okay. Now, the upstream adjustment I'm talking about is that it was the investee, which is the associate that sells to the investor, which in this case could be the parent. And in that light, what happens is that the unrealized profit will be adjusted for.
Yes, I see your screen.
Yeah, the unrealized profit will be adjusted for against the cost of sales, which will affect the profit or loss of the subsidiary. And a credit which adjustment will affect the consolidated or the group inventory, okay? Or because the inventory in contest is sitting in the books of the investor, which is the parent, because it's the parent that is carrying the inventory, having bought such from the associate. Likewise, the excess depreciation adjustment will be a debit adjustment to the group PPE, okay, and a credit adjustment to the group profit or loss, which more or less is a reduction in the amount of cost of sales. And that is that. And that is provided you treat your depreciation within cost of sales. If not, if your depreciation is not treated within cost of sales, it will be adjusted against element of administrative expenses. Now, also on asset losses. Now, when the equity method is being used, an investor share of losses of the associates equals or exceeds the interest in the associate, the investor should discontinue including his share of further losses. What we are trying to say is this: you can't have negative value for an associate. Your equity interest in an associate cannot go to negative, which means the worst that can happen to you is that your whole investment is zero, which means your whole value is eroded. But there's an exception to that, which means that where you also have a form of guarantee or order on the associate, your loss can be recognized to the extent that your value of equity in the associate can be negative, subject to the amount of guarantee or obligation you can assume on behalf of the associate. That's why further, it was stated here that the interest in an associate is normally the kind amount of the investment in associate, but it also includes any other long-term interest, for example, long-term receivables or loans. Okay, after the investor interest is reduced to nil, additional losses should only be recognized where the investor has assumed obligation or made payment on behalf of associates. For example, if it has guaranteed amount owed to third parties by the associate. Otherwise, the lowest level you can go to is zero and not negative. Okay, impairment loss on associates. Okay, the requirement of IFRS 9 equally applies, which shows, which give indicators of when investment in any form of financial asset will have been impaired. But impairment loss on associates will be determined in line with the requirement of IS 36. as opposed to the requirement of IFRS 9 in terms of determining the impact. But again, as we have said earlier, any impairment loss on equity is more of a permanent nature, and such cannot be reversed. You must take note of that. And the reduction, the impairment loss will be used to reduce the kind amount of investment in an asset and will also be charged directly to the profit of the investor. Likewise, in conclusion, dividend received from an associate, okay, where dividends have been earned as an income and equally received from an associate, in the process of equity accounting, you must reverse such a dividend and replace it with the share of asset profits. And this is synonymous to what we did yesterday, okay, which says that you cannot recognize share of profit and at the same time to have recognized portion of that profit that is paid out as dividend. Therefore, what do you have to do? Since dividend has been recognized in your separate financial statement before, such will have to be reversed at the point of equity accounting in order to allow you to recognize the share of profit in associate, as we have done yesterday in part 1 and as we have done also now in part 2. Okay, any other question? These are the critical adjustments that will arise in the process of accounting for your investment in an associate in line with the requirement of IAS 28. Any other question, clarification, contribution, or otherwise? Any contribution?
Okay, just to, based on what you said, that the investment in associates cannot go below 0, except institution where the parent has guaranteed some maybe loan repayment or receivable or whatever. So in that case, now we categorize.
In that case, what happened then is your investment in associates can go towards negative, which means you'll be recognizing it not longer as an investment, but it's now an application.
Down to the.
I
didn't get that. The network. The network was bad. You said
His network
you're
is
not
bad.
qualified. Just come, take it again, please.
No, what we are saying is this. If your share of loss in an associate is such that he has eroded all your investment, therefore you discontinue the recognition of additional share of losses because you're already at ground 0, which means you only recognize share of loss to the extent that it brings your investment to 0. Now, the only time you continue to recognize such share of loss is to the extent of any obligation you are to assume on behalf of the associates. And such obligations arose from the fact that 1, you might have guaranteed some of the obligations of the associate. And 2, you might have incurred some cost on behalf of the associate to which you believe such amount will be receivable from the associate. And in the event that such is not receivable, it then means that it's more or less additional burden on you. Does that make sense to you now? Okay. Okay, let's wrap it up.
Okay,
Yeah. Enaro, I can hear you.
No, I didn't get that last part, no problem.
No, I think your network is breaking every minute.
Let's continue.
Okay. Shagun, over to you.
Yeah, the question is that I'm reviewing a financial statement and I saw a line item credited to the income statement that states manufacture for own use was credited into the profit or loss. Though I tried to check the notes to the account and there was no explanatory note to that effect that tells me which account was debited for them to have credited an amount to profit or loss, manufacture for own use. And this is a material item. So I want to know what could have happened and how should I address that?
Okay. Additional information which should be obtainable from the notes financial statement should be able to provide guidance. But since you don't have that information, it might not be practicable for me to assume anything because the language used is not a standard language, or it's not a common transaction, which means you must understand the substance of that transaction before you can be able to make any recommendation with respect to the treatment or measurement. But again, I tried to reflect. In which section of the income statement was that presented?
It was presented directly under the revenue for the year.
Okay, under the revenue.
Yeah,
okay.
Just immediately after they had the revenue item, then the next item was manufacture for own use, and is also an income.
Okay. I get what they are trying to do. I think what they are trying to explain is this. Revenue accounted for is both revenue from third parties and revenue that is derived from the consumption by the business. Now, let me give you a typical example of how such can be reported, okay, or how such may have been reported. Now, let me pick, for example, if you consume part of what you produce, you are oil and gas company. For example, you sell petroleum products, you sell diesel, okay? And at the end of the day, you also have generator in which you buy petrol from yourself to consume. Therefore, you are trying to distinguish revenue earned from third parties from revenue that is notional. Notional in the sense that as it is revenue or income to you is exactly the cost to you also somewhere else, which is like in and out. I suspect that is what it is, which means it's a notional revenue, which also has a notional cost, which is in and out. Because if you buy petrol or diesel to fuel your generator as oil and gas company, you will have reported that you sold the diesel and you must have earned revenue. And the cost also will have gone into your own cost in one way or the other as cost of sales, which means it's like netting it off. But what will now happen is that you can't recognize profit on such a transaction. Therefore, the revenue will be recognized to the extent of the value of the cost, which means it's going to be exactly the cost amount, because you can't make profit within yourself. Profit must be something derivable from a third party. And in this case, you are not a third party. Therefore, such a notional revenue or income will be reported at the actual cost to the entity. That is from the little information I've gotten from you, what I can deduce. But again, such information, I suspect that if you check the accounting policy on revenue, not necessarily the breakdown of revenue in the notes, you will also see such information there. Just go and check. Or if you can share that document with me, it's also going to be valuable.
Okay, it's all right. Secondly, there's other one, they said other long-time expenditure was capitalized in the balance sheet. I realize that this should be derecognized.
No, okay, it's a function of what is a long-term expenditure. Okay, what do they mean by long-term expenditure? Because the issue that borders on capitalization starts from the nature of the expense and also the substance, whether such an expenditure, I will use the word expense, such an expenditure or cost is what will bring about economic benefit derivable by the organization over a period of time that spans beyond 1 year. If that is the case, they might be right to have capitalized it. If not, that will be completely an error of application of the principle of financial reporting.
Okay, I understand what I would do, because looking at the note to the financial statement is not explanatory enough and it's not complete. So
Okay.
I will request for further information from the organization.
Okay, no problem.
Thank you.
Okay, thank you very much, guys. God bless you all. Okay.
God bless you too.
Yeah, bye.